Folks, we've had a semantic debate all week on what is a recession. So we received our long-awaited number on GDP, and unfortunately, it was a negative number. So that gives us two back-to-back quarters of negative GDP. And the reason why I say it's a semantic debate is some economists are arguing that we are not in a recession.
Right. I mean, not just economists, also the president and Janet Yellen and even Jerome Powell from the Fed all suggested that with unemployment below 4%, you don't really have the criteria that would typically match a recessionary environment. And again, we've talked over and over about the magnitude of this bear market decline, and that the magnitude of which will be defined by whether we avoid a recession or whether we have a shallow growth trajectory for a few months.
You look at these two back-to-back quarters of negative GDP, and there's no question that is a slowing of the economy. But what the Fed is doing right now in an effort to try to fight inflation is raising interest rates, and these interest rate impacts are still yet to be determined because this could happen again in next year, and that is my concern, that we're going to have a slowdown now, and then these Fed rate hikes are going to kick in perhaps next year. And so that's the reason why we're paying a lot of attention to this. But there's no question that we've seen businesses cut their inventory. We've seen housing markets start to slow down. In fact, these higher rates are certainly slowing down the economy, not to mention supply chains still remain under stress.
Right. And, as the Fed is trying to weaken demand, they're trying to do this in the context of things on the supply side they really have no control over. They can't control what Putin does in Ukraine or with natural gas going to Europe. They can't control what the supply chain issues have been in semiconductors. They can't control the fact that a lot of people don't want to go back to work. So it really is an interesting situation that they find themselves in. But I have to say, what we saw this week with the market suggests that the maximum pessimism is passing. And just think about what we had this week. We had a huge miss on GDP, yet the markets went up. The Fed raised Fed funds rate by 75 basis points, said their focus remains on inflation, yet the markets rallied. Russia turned down the gas flow to Europe, markets rallied. And when bad news doesn't take markets down, it really causes people to rethink their theses, because at the end of the day, the market will anticipate a turn well before the economic data does.
That is for sure. And that's on a macro look. On a micro look, we're seeing the earnings reports come out, and a lot of S&P 500 companies have reported, and their earnings have been good.
Right. The median beat has been 7%. 76% of those reporting beat estimates. Overall, a median of 4% beat on the top line. I would point out, though, that the beat rate is the lowest we've seen since the first quarter of 2020. So directionally, it's going the wrong way. But I would just characterize earnings season thus far as much better than feared.
And so you look through all of these companies, at the end of the day, that is something the markets will look at. If a company increases its revenue and perhaps its net income, then you can look at multiples. And that is something we spent a lot of time, because what we have seen in this contraction that we've seen in this bear market is that multiples have contracted, but earnings really haven't.
In fact, it's the second largest derating of multiples in 30 years, with the multiple going down 6.7%. That's more than what we saw during the financial crisis. It's more than we saw during the pandemic. So the price action alone has discounted a lot of negativity. But this week, we had any number of great reports. Apple had a great report. Amazon had a great report. The oil companies on Friday reported gushing profits. I'm sure that'll get the attention of someone in Washington. Microsoft, while it missed on top and bottom line, gave good guidance in the conference call. So the big tech companies have actually delivered in a softening growth environment.